Hi again. It's common during times of volatility in the markets, people tend to look for low risk investments, and sometimes they're the right fit. Often what's wrong about them is when people move them in and out of their accounts. I'm not going to be getting into that in this video, but really, is it the appropriate thing for your goal? So today I'm going to be going over a few of those lower risk investments at a higher level view of what they are and how they would fit into your plan. Today we'll be talking about CDs or certificates of deposit, municipal bonds or bond funds, and money market accounts or money market funds. First, a CD. A CD or certificate of deposit. It's a deposit account offered by banks and credit unions. When somebody buys a CD, they agree to leave their money untouched for a period of time, sometimes 6 months, 1 year, multiple years. In return, the bank pays a fixed rate. So why do people use them? Well, typically for safety. CDs offer safety in that they're insured by the FDIC up to applicable limits, making them one of the safest places to hold cash. The interest rate is locked in so the clients know exactly what they earn, and most of the time they make more money than having money just in a savings account. So they would make sense for clients who want a guaranteed return, don't need access to the funds, and really prefer that low risk option. That's where CDs come in. But what about municipal bonds? They're a little bit different. They are also low risk, but they're issued by state and local governments looking to raise money for public projects often. When somebody buys a muni bond, they're essentially lending money to a municipality in exchange for interest payments. So why do people use them? Well, municipal bonds can have tax advantages. Most of the time, the municipal bonds interest is federally tax-free. And if the investor lives in the state where the bond is issued, it may also be state tax-free. Sometimes people use muni bonds for income. They tend to they're looking for a predictable income in the interest payments. And they tend to be lower risk than many corporate bonds. While they're not risk-free, most municipalities have strong credit histories. And then there are money markets or money market funds. So what they are, money market funds invest in very short-term, high-quality debt instruments like treasury bills and commercial paper. Money market accounts at banks function similarly, but they're deposit accounts rather than investment funds. Well, why do people use them? Well, money market funds tend to be used more when people want liquidity. They can be accessed quickly, making them ideal for cash reserves. And stability, they aim to maintain a stable value. Usually it's $1 a share for funds. And often they have competitive yields. In rising rate environments, money market funds often adjust faster than CDs or savings accounts. So why do they make sense? Well, they're great for emergency funds, for short-term savings, or as a temporary parking place for cash investments. Well, how would these investments fit into a client's financial strategy? Well, these three vehicles are popular because they help clients protect principal, generate income, manage taxes, and match investments to time horizons. And they tend to reduce overall portfolio risk. What they don't do historically is make a lot of money. Risk versus return, there is a balance. And for reference, I looked at the average returns for these investments nationally over the past 20 years. Different regions pay different amounts, but generally speaking, CDs for the past 20 years have averaged about 1 to 2%. Municipal bonds around 4 to 5%. And for the past 20 years, money market accounts or money market funds have averaged about 2 to 3%. Now, keeping in mind that there was a long protracted time where interest rates were very, very low, when the Fed had the rates pretty much at zero, that did affect these investments. So yes, they were low risk, but they were also extremely low return during a lot of the years in the last 20. By comparison, if you had a 60-40 portfolio, 60% of your money in let's say the S&P 500 and 40% in the aggregate bond index, typical retirees balance, if you will. Over the last 20 years, that would have averaged just under 8%. So yeah, it's a lot better return, but you're dealing with the risk. So those are the value judgments you need to make. But for most advisors, they would not recommend all your money in one or the other. It's putting the pieces together to make the proper portfolio for you. In my opinion, the proper use for any of these investments is either as a piece of an overall portfolio, creating that pie, or using the bucket strategy to where you know you're going to need money in the short term, keep the risk low, keep the return predictable, money you may not be needing for some time, and you'd like to grow your wealth, but are willing to deal with the risk. That's where you use the higher risk investments. Again, very general statement. As I recommend pretty much with all my videos, do your planning, work with somebody who can help you create the plan that fits you personally. Thank you.